Most traders notice strong candles on the chart. They see a fast move and assume the trend is strong. But what they don't notice is what happened inside that move. Because when price moves very quickly, it often leaves behind an imbalance, a section where buying and selling didn't fully match. That imbalance is called a fair value gap. And these gaps matter because markets often return to them later to rebalance liquidity. This indicator automatically tracks those inefficiencies for you, showing where price skipped trading, which zones are still open, and which ones have already been filled. Let me walk you through exactly how it works and how to trade it. Open TradingView and load any chart you want. I'm using the 15-minute time frame here, but this works on all markets and time frames. Click Indicators, search for Fair Value Gaps by DGT, and add it. As soon as it loads, you'll see rectangular zones appear directly on your chart. Some zones will be above price, some below. These boxes represent areas where price moved quickly and left behind a trading imbalance. The indicator continuously tracks whether each gap is still open, partially filled, or fully resolved. Look closely at one of the zones. You'll notice it forms after a strong directional move. Typically, a large candle pushes price quickly, and the surrounding candles don't fully overlap its range. That creates a small area where price essentially skipped trading. That skipped area is the fair value gap. These zones highlight liquidity inefficiencies, where price may later return to rebalance supply and demand. If the gap is bullish, the box usually forms below current price. If it's bearish, the box appears above. As price moves forward, the indicator keeps extending these zones so you can see if price comes back to interact with them. You may also notice that some zones overlap. When multiple gaps stack in the same area, that often reveals stronger institutional activity or important repricing levels. That's usually where reactions become more meaningful. One useful feature of this indicator is that it doesn't just draw boxes and forget them. It tracks their life cycle. When a gap first forms, it's considered unfilled. That means price hasn't come back yet. When price starts trading into the zone but doesn't fully close it, it becomes partially filled. And when price trades through it completely, it becomes resolved. This helps you immediately understand which zones are still active and which ones are no longer important. Another powerful aspect of this indicator is that it can visualize imbalances from multiple time frames. That means you might be looking at a 15-minute chart while still seeing gaps formed on higher time frames. This matters because higher time frame gaps often carry more weight. Seeing them together gives you structural context without switching charts. Double-click the indicator to open settings. You'll usually see options related to time frame selection. This controls whether the indicator shows only current time frame gaps or includes higher time frame ones. Display options. These let you adjust colors or visibility for different gap states. Extension settings. This controls how far the zones project forward on the chart. Once everything looks readable, click OK. Now, before we get into the actual strategy, let me share something that changed how I trade. You can learn this setup perfectly, but if you're not at your screen when it triggers, you miss it. And that used to happen to me constantly. That's why I started automating strategies like this, back-tested setups that run whether I'm at my desk or not. These work across forex, futures, gold, and they even work at prop firms. If you want access to the exact strategies hundreds of traders are already using, check the first link in the description. Long setup. First, identify a bullish gap below price. This usually forms after a strong upward move. Now wait for price to retrace back into that zone. You don't want to buy immediately. You want to see how price behaves when it returns. If price enters the gap slowly and then prints a bullish candle rejecting the lower part of the zone, that suggests buyers are defending the imbalance. That's your long trigger. Place your stop slightly below the gap, because if price fully breaks through it, the imbalance has failed. Targets can be the previous high, the next resistance zone, or the next visible imbalance above. You're essentially trading the idea that once price rebalances the gap, it often continues in the original direction. Short setup. Now flip the logic. Find a bearish gap above price. Wait for price to rally back into that zone. If price moves into the gap and then prints a bearish rejection candle, that's your signal sellers are stepping back in. Enter short on confirmation. Place your stop just above the gap. Targets can be the next support or imbalance below. Again, the idea is that price often revisits inefficiencies before continuing the trend. Sometimes price doesn't respect a gap. Instead, it breaks through it. When that happens, the zone can flip roll. A bullish gap broken downward can become resistance. A bearish gap broken upward can become support. This happens because traders who expected a reaction, they are now trapped, and their positions reinforce the opposite move. If you're a serious trader trying to get funded, you need more than a single tool. You need a full toolkit consisting of elite algos that catch the best moves while avoiding losses in sideways markets, proven strategies across multiple markets, whether forex, gold, or futures, with a risk management built in and fully automated systems so you can trade without being at the screen all day. So if you'd like to stop burning your time and account testing random indicators and start using elite tools and automation like all these other traders, click the link below. Market-specific tuning, forex. Gaps form frequently during strong session moves. London and New York sessions often create clean ones. Crypto, volatility creates many small gaps, so focus more on higher timeframe ones. Stocks, daily and 4-hour gaps tend to carry the most weight. Gold tends to respect higher timeframe imbalances very precisely, especially during major news-driven moves. This indicator doesn't tell you what price will do. It shows you where the market previously moved inefficiently and where liquidity might still need to rebalance. Thanks for watching, and I'll see you in the next one.